You're sitting at your kitchen table on a random Tuesday night, and you open up your investment app just to check. Maybe you've done this 100 times before, but tonight something is different. The number staring back at you has 6 digits, and the first one is a 2. $250,000. You blink. You do the math in your head. You think about every automatic transfer, every time you said no to the nicer apartment, every bonus you didn't blow on a vacation. And then this weird feeling hits you. It's not just pride. It's not just relief. It's something else entirely. It's like the rules of the game just changed, and nobody told you it was coming. Here's what I want to talk about today. There's a moment in your financial life where the math starts working differently, where compound interest stops being this abstract concept you learned about in school and starts becoming something you can actually feel, where your money begins doing more of the heavy lifting and you begin doing less. That moment, for a lot of people, happens somewhere around $250,000 invested, and what happens after you cross that line is genuinely different from everything that came before it. But here's the thing most people miss. The journey to $250,000 matters just as much as hitting the number itself, because the habits, the mindset, and the skills you build on the way up are exactly what allow you to keep going once you get there. So today, I want to walk you through what actually changes at this milestone, why it matters so much psychologically and mathematically, and most importantly, what you should be doing before you hit it, and what shifts after you do. I'm someone who thinks about money constantly. Not in an obsessive way, but in a curious way. I've spent years trying to understand why some people build wealth and others don't, even when their incomes look similar. And what I've found is that money is mostly a psychology game dressed up as a math problem. If this kind of thinking helps you see your own finances more clearly, consider subscribing and hitting the like button. It helps more people find these videos, and it lets me keep making them. Okay, let's get into the myths first, because there's a lot of noise out there about what it takes to build wealth, and most of it misses the point. Myth number 1 is that you need to earn a massive income to ever accumulate real money. You hear this all the time. People assume that anyone with $250,000 invested must be making $200,000 a year or more. But the data tells a different story. According to surveys from the Federal Reserve and various financial institutions, the correlation between income and wealth is way weaker than you'd expect. There are plenty of people earning 6 figures who have almost nothing saved, and plenty of people earning $60,000 or $70,000 who have been quietly building serious portfolios for years. The difference isn't income, it's behavior. Myth number 2 is that investing is complicated and risky, and you need to be some kind of expert to do it well. This one keeps so many people on the sidelines. They think they need to understand options trading, or pick individual stocks, or time the market perfectly. But the truth is, the most reliable path to building wealth is also the most boring one. Low-cost index funds, consistent contributions, and time. That's it. You don't need to be a genius. You just need to be consistent. Myth number 3 is that $250,000 is either impossibly far away or not that meaningful. Some people hear that number and think it's completely out of reach. Others hear it and think, well, that's not even close to retirement money, so why does it matter? Both reactions miss what's actually significant about this milestone. It's not about the number itself. It's about what the number represents and what it enables. Let me explain what I mean. When you have nothing saved, or only a few $1,000s, you're in survival mode. Every unexpected expense is a crisis. Every paycheck feels like it disappears the moment it arrives. Your brain is constantly scanning for threats, constantly stressed about making ends meet. Behavioral economists call this the scarcity mindset. When you're operating in scarcity, your cognitive bandwidth gets eaten up by worry. You make worse decisions because you don't have the mental space to think long term. You're focused on getting through this week, not building for the next decade. Research from places like Princeton and major financial institutions has shown that financial stress literally impairs decision-making. It's not that people without money are less smart or less capable. It's that the stress of not having enough hijacks the brain's ability to plan and think clearly. This is why the first stage of building wealth is so hard. You're fighting against your own psychology. But something shifts when you start to accumulate a real cushion. When you have $20,000 saved, you can handle most emergencies without going into debt. When you have $50,000, you start feeling like you have options. When you hit $100,000, you begin to believe that this whole wealth building thing might actually work for you. And when you cross $250,000 invested, something fundamentally changes in how you experience money. Here's the math behind it. Let's say you're investing in a diversified portfolio that earns, on average, somewhere around 7 to 8% per year over long periods. I'm using historical stock market averages here, which is what major indexes have returned over decades, though of course past performance doesn't guarantee future results, and there will be years when returns are higher or lower or even negative. When you have $10,000 invested, a 7% return gives you $700 in a year. That's nice, but it's not life-changing. You're still doing almost all the work yourself through your contributions. When you have $50,000 invested, that same 7% return gives you $3,500. Now we're talking about a noticeable chunk of money, almost $300 a month that you didn't have to earn at your job. When you have $100,000 invested, 7% gives you $7,000 a year. That's real money. That's almost $600 a month working for you. But when you hit $250,000, 7% returns give you $17,500 in a single year. That's nearly $1,500 a month that your money is generating. For a lot of people, that's a significant portion of their monthly expenses being covered just by investment growth. And here's where it gets really interesting. If you're still contributing, say, $1,000 a month on top of that, your portfolio isn't growing by $12,000 a year from contributions. It's growing by $12,000 plus $17,500. Nearly $30,000 in a single year. That's the momentum effect. That's when you start to feel like you're rolling downhill instead of pushing uphill. Let me put this another way. Let's say you start from zero and save $1,000 a month. With average market returns, it takes you roughly 7 years to hit your first $100,000. But once you have $100,000, it only takes about 4 more years to get to $200,000. And once you have $200,000, it takes less than 3 years to get to $300,000. The time between milestones keeps shrinking because your money is doing more of the work. This is the compounding curve in action. It starts slow, painfully slow. The first $100,000 is a grind. But once you build that base, the acceleration kicks in. And $250,000 is roughly where most people start to really feel that acceleration in a tangible way. But here's what I think matters even more than the math. It's the identity shift that happens along the way. Because to get to $250,000 invested, you had to become a different kind of person than you were when you started. Think about what it actually takes. You had to set up automatic transfers and stick with them for years. You had to watch your friends buy nicer cars and go on bigger vacations and resist the urge to keep up. You had to track your spending, probably multiple times, and make adjustments when things got off track. You had to keep investing during market downturns when every headline was screaming that the sky was falling. You had to delay gratification over and over and over again. That's not just saving money. That's building a skill set. That's developing discipline. That's proving to yourself that you can control your financial life instead of letting it control you. And this identity piece is actually more valuable than the money itself. Because the person who can do all of that, who can delay gratification, who can think long term, who can stay calm when everyone else is panicking, that person is going to keep building wealth no matter what happens. The $250,000 isn't the finish line. It's proof that you've developed the character traits that make wealth accumulation almost inevitable over time. Let's talk about what you should be doing before you hit this milestone. Because the habits you build now are what determine whether you ever get there and what happens after you do. First, automate everything. The single best thing you can do for your financial life is remove yourself from the equation as much as possible. Set up automatic transfers from your checking account to your investment accounts. Make it happen right after you get paid, before you have a chance to spend the money on something else. Behavioral research consistently shows that automation dramatically increases savings rates because it leverages our tendency toward inertia. Once it's set up, you have to actively choose to stop it, and most people won't. Second, keep your investment approach simple. This is not the time to try to beat the market or pick individual stocks or chase whatever is hot right now. Low-cost index funds that track the broad market are probably your best friend at this stage. They give you instant diversification, they keep fees low, and they remove the temptation to tinker. Every dollar you lose to fees or bad stock picks is a dollar that won't compound for you over the next few decades. Third, keep your big fixed costs under control. This is where most people quietly sabotage their wealth building without even realizing. The average new car payment in America right now is somewhere around $700 a month, and many people are paying even more than that. The average rent in major cities keeps climbing. These big recurring expenses are what eat up your ability to save and invest. Here's a useful way to think about it. Every $500 a month you spend on a car payment instead of investing is roughly $350,000 you won't have in 20 years, assuming average market returns. That's not an exaggeration. That's just compound interest math. The car depreciates and disappears. The investment grows and compounds. The gap between those two paths is enormous over time. Fourth, focus on your income, not just your expenses. There's only so much you can cut, but there's theoretically no limit to how much you can earn. Whether it's negotiating a raise, developing new skills, changing jobs to move up, or building a side income, increasing what you bring in accelerates everything. And here's the thing most people don't realize. Your savings rate matters more than your income in terms of how fast you build wealth. Someone earning $80,000 who saves 30% will build wealth faster than someone earning $150,000 who saves 5%. But if you can increase your income while keeping your expenses relatively flat, you get the best of both worlds. Fifth, and this is psychological, start thinking of yourself as someone who builds wealth. This sounds fuzzy, but it matters. The stories you tell yourself about who you are shape your behavior. If you think of yourself as someone who's bad with money, you'll keep making decisions that confirm that belief. But if you start thinking of yourself as someone who's building something, someone who makes smart, long-term choices, you'll find it easier to act accordingly. This isn't about positive thinking or manifestation or any of that. It's about identity alignment. Your actions follow your self-concept. Now let's talk about what changes after you hit $250,000 and what you should do differently. The first thing that changes is your relationship with risk. When you had nothing, every risk felt like it could destroy you. Because it could. One bad break and you're in debt, behind on rent, scrambling. But with a solid base of $250,000 or more, you can afford to take calculated risks that you couldn't before. Maybe that means allocating a small portion of your portfolio to higher risk, higher reward investments. Maybe it means taking a chance on a career move that could pay off big but has some uncertainty. Maybe it means investing in your own education or skills in a way that costs money up front but increases your earning power. The point is, having a cushion gives you options, and options have real value. The second thing that changes is access. Once you cross certain thresholds, financial products and opportunities open up that weren't available before. Some investment funds have minimums of $50,000 or $100,000. Some require even more. As your portfolio grows, you may get access to lower fee share classes of mutual funds, or be able to negotiate better terms on things like mortgages or loans. You might qualify for private banking services or financial planning that wasn't cost-effective before. These advantages compound too. Lower fees mean more of your returns stay in your pocket. Better advice helps you avoid costly mistakes. The third thing that changes is your mindset around optimization. Before $250,000, the game is mostly about accumulation. Just get money into investments, keep your head down, and keep contributing. But after you hit this milestone, it starts making sense to think more strategically. This is when you should really look at your asset allocation and make sure it matches your goals and timeline. This is when tax strategies start mattering more. Things like tax loss harvesting, asset location between taxable and tax-advantaged accounts, Roth conversion strategies, and so on. This is when it might be worth paying for professional advice, because the dollars at stake are large enough that even small optimizations can have meaningful impacts. The fourth thing that changes is how you think about major life expenses. When you have $250,000 invested, the opportunity cost of big purchases becomes very real and very visible. That $50,000 car isn't just $50,000. It's $50,000 that could have compounded for decades. At average market returns over 20 years, that's potentially $200,000 or more. Is the car worth that? Maybe. Maybe not. But you should at least be asking the question. This is true for housing too. The difference between a house that costs $300,000 and one that costs $450,000 isn't just $150,000. It's the future value of that money if you had invested it instead. Plus higher property taxes, higher insurance, higher maintenance, higher everything. People consistently underestimate how much house-related expenses eat into their ability to build wealth. I'm not saying you should never buy a nice car or a nice house. Life is for living, and money is ultimately a tool to support the life you want. But I am saying that once you have real money working for you, every big spending decision should be weighed against the alternative of letting that money compound. Sometimes the purchase is worth it. Often it's not. Let's talk about how this milestone changes your relationship with your career and work. Because this is one of the most underrated benefits of building wealth. When you have nothing saved, you have zero negotiating power. You need your job because you need next month's rent. You'll put up with a bad boss, a toxic environment, or below market pay because you can't afford to leave. You're trapped. But when you have $250,000 or more invested, you have what I call walk-away money. Not enough to retire, not enough to never work again, but enough to survive for a while if things go sideways. Enough to be selective about your next opportunity. Enough to say no. This changes everything. You can push harder in salary negotiations because you're not desperate. You can leave a job that's making you miserable without panicking about next month's bills. You can invest in your own development, pay for that certification or conference or training because you have resources to deploy. And here's the positive feedback loop. When you negotiate better, you earn more. When you earn more, you can invest more. When you invest more, your money works harder for you. When your money works harder, you have even more negotiating power. Each step reinforces the next. But I have to be honest about the dangers too, because there are very common ways people blow it once they hit this milestone. The first and most common is lifestyle creep. You hit a number, you feel good, and you start spending like you've made it. The apartment gets upgraded, the car gets upgraded, the vacations get upgraded. Before you know it, your expenses have grown to match your assets, and you're back on the treadmill again. The $250,000 that should have been your springboard to the next level instead becomes a plateau you never leave. The second trap is treating the milestone as a spending reward. There's a weird psychology where hitting a big number makes some people feel like they've earned the right to blow money. They hit $250,000 and immediately buy a $40,000 car to celebrate. Now they have $210,000 and a depreciating asset. They just set themselves back years. The third trap is getting overconfident and taking stupid risks. Some people hit a milestone and suddenly think they're investing geniuses. They start picking individual stocks, trading options, trying to time the market. They take concentrated positions in speculative assets. Sometimes they get lucky. More often, they give back a big chunk of their gains and learn an expensive lesson. The fourth trap is stopping. This sounds counterintuitive, but some people hit a number and just coast. They stop contributing as much. They stop paying attention. They figure the money will take care of itself. And while compounding does work in your favor, continuing to contribute accelerates everything. The difference between contributing and not contributing over the next 10 or 20 years is massive. So what should you do instead? Here are the principles I think matter most. Keep your big fixed expenses in check, even as your wealth grows. This doesn't mean living like a monk. It means being intentional about the major recurring costs that lock in your lifestyle. Housing, transportation, recurring subscriptions and memberships. These are the things that quietly drain your ability to build wealth over time. Automate your investing and try not to look at your portfolio too often. Checking daily or weekly just invites emotional decision making. Set up your contributions, choose a sensible asset allocation, and then let time do its work. The less you tinker, the better you'll probably do. As you hit milestones, consider working with a fee-only financial advisor who's a fiduciary, meaning they're legally required to act in your best interest. At $250,000 and beyond, the cost of good advice is usually far outweighed by the value of avoiding mistakes and optimizing your strategy. Keep increasing your income. Never stop. Your earning power is your biggest asset, especially in the earlier stages of wealth building. Invest in skills, relationships, and opportunities that make you more valuable in the marketplace. And maybe most importantly, remember why you're doing this. The point isn't to have a big number for its own sake. The point is freedom, options, security, the ability to design your life instead of just reacting to it. Keep that end goal in mind when you're tempted to blow money on something that doesn't actually move you toward the life you want. Here's the bottom line. $250,000 invested is a turning point. It's where compound interest starts pulling its weight. It's where opportunities open up that weren't available before. It's where the whole game starts to feel different. But the magic isn't really in the number. The magic is in who you become on the way there, and what you do after you arrive. The habits of consistency, delayed gratification, and long-term thinking that get you to this milestone are the same ones that will carry you to the next one, and the one after that. If you're not there yet, don't be discouraged. The first part of the journey is the hardest. You're doing the work that most people never do. Keep going. The math gets easier. The momentum builds. And one random Tuesday night, you'll open your app and see a number that changes how you think about everything. If you're already past this point, congratulations. You've done something most people never will. Now the question is whether you'll protect and build on what you've created, or let lifestyle creep and bad decisions erode it away. Stay humble. Stay disciplined. Keep going. I'd love to hear from you in the comments. Where are you on this journey? Are you grinding toward your first 100,000? Closing in on 250? Already past it and thinking about what's next? Drop a comment and let me know. And if this video helped you see your own financial path more clearly, hit that like button and subscribe. It really does help the channel, and it lets me keep making videos like this one. Thanks for watching. I'll see you in the next one.